Well, what a week it's been from the very start, with worries brewing over inflationary data only to then be confirmed report by report to ultimately drive all of us deeper into the red. However, thanks to all the fear out there, I not only went on a bit of a buying spree this past week, spending over $2,600, but I have one heck of a list of dividend stocks for you to load up on right now and simply hold for the long term. But before I actually cover those dividend stocks, I want to key you in on all the need-to-know macroeconomics so you can sleep a little bit easier at night. With that, are you ready? So let's kick this off where we always do, with our macros, because investing is all about remaining calm when the masses of the market are in total panic, like right now, simply because they can't piece together the future, or at least to the best that they can, which is ultimately called uncertainty, something that us humans don't really sit too well with. Anyhow, what you need to know are really two things, and I harp on them constantly here on the channel, because they are our market mandates. The first being the inflationary data, and the second market mandate being the interest rate cut timeline. They ultimately work in tandem to drive you stir crazy. But this past week, everything came down to the fresh inflationary report that was released on Wednesday and depicted the consumer prices grew by about 0.4% and inflation grew by 3.5% from a year earlier. This all resulted in a selling frenzy as we move in the opposite direction of the Federal Reserve's goal of 2% inflation. And that all means that we're just unlikely to see interest rate cuts anytime soon. A matter of fact, this past week, we also received the latest FOMC meeting minutes, whereas we deduced that the concern is exactly that out of the Federal Reserve. And as I've shared before on the channel, maybe 2 or 3 videos ago now, we may not even see all 3 interest rate cuts that we originally anticipated as we entered this year, because Jerome Powell ultimately just keeps saying everything is contingent upon the data, and the data is not so hot. It just seems that with each passing day, the rate cuts are actually pushed back further and further because the Fed lacks the very confidence to pull the trigger on the interest rate cut gun. Now, I'm not going to be that I told you so guy, but I just have a very strong feeling we won't see all 3 rate cuts this year, and that sentiment is actually shared by many on Wall Street. I'll leave it at that, but what does that then mean for you and I as investors? Well, if we remain in this environment for a longer period of time, higher inflation and elevated interest rates, it's really going to be a survival of the fittest-like environment for businesses and consumers, which all just means that you got to be really cautious with what you're investing into and when you're investing into these companies or selling out of them. Luckily for us dividend investors, well, we can get invested into a high-quality company and just hold on to it for the long term and enjoy all of the dividends. That leads me to the 6 stocks that I'm hyped about, and I am talking about being all in on. Let's get to them here with the very first dividend stock being Starbucks, ticker symbol SBUX. Starbucks is up first as our beloved global coffee chain that just continues to expand and produce for all of our sugar addicts out there. But more recently, upon the economic news, forecasts really being changed given consumer trends will probably change, is actually now impacting Starbucks. We see that the share price is down to $85 per share, which is ultimately down by 10% on the year, with a major decline this past week. But let's zoom out to see over 200% worth of growth this past decade. Analysts are also very bullish on the stock for the long term, with the share price returning to $107.22 per share. That's over 24% worth of upside. And then we have a solid dividend coming in with Starbucks at 2.65% worth of a dividend yield, a streak that hits 13 years back, and check this out, a growth rate on average here of 17% year over year. Next up, I want to remain within the food and dining realm with Darden, ticker symbol DRI, which operates America's most popular branded restaurants, talking about like Olive Garden, Longhorn Steakhouse, to their more elegant Capital Grille and Eddie V's for all of the seafood lovers out there. But have a look now at the share price. After recent data sets, Darden fell and is currently trading for just $155 per share with a PE ratio at 18.3. Yet zoom out with me to see overall growth over the last decade, upwards of 383% worth. So in my opinion, and just knowing how we all operate as humans, whether the economy is good or bad, there is a need for treating ourselves and our families at restaurants. And I think we have a solid comeback play, as do all of the analysts out there, coming up to a share price, forecasted share price of $180.53 per share, making for 15+% worth of upside. And until then, you will really be able to feast on Darden's dividend, coming in at a yield of 3.36%, which has been growing on average by 23% year over year, though at times, given the industry, they have experienced cuts, it is a solid dividend player because that dividend will always likely be there. Now, investors, there's 2 dividend stocks out of the 6, so 4 more to go. But before I actually cover them, I actually discovered a very interesting stat that I want to share with you. I just looked into my YouTube analytics and discovered that 82.6% of you aren't even subscribed, which tells me just how serious, or rather not so serious, you are as an investor. So take the opportunity right now to take massive action. Join me on this journey and let's crush our goals together. That's all you have to do is subscribe to the channel here. And while you're at it, let me know that this very video was well worth your time by tapping on that thumbs up button for me. That goes a heck of a long way in telling me that this is actually providing value for all of you, and I'll then keep creating content like this. With that, we're going to dive right back into it with Medtronic, ticker symbol MDT, which is a medical device company that since COVID has really been in a rut as hospitals and medical facilities focus more on cost-cutting measures. And that game really remains at play today, meaning we get a depressed share price coming in at $82 per share. But I want you to take note of the fact that the spikes that you're actually seeing on screen right now are when we get into the good economic news, and then we duck out of them and we see these nosedives, ultimately upon hearing inflationary data. So we can zoom in here to see ourselves in the red, but with a long-term approach and zoom out to 10 years, we can see almost 80% worth of share price appreciation. Not to mention all the confidence from hedge funds pouring in with over 7.2 million shares purchased last quarter. And we have a ton of confidence from analysts as well, 14% worth of expected upside, coming up to a share price of $94 per share. And while we wait, we're going to enjoy some dividend income with Medtronic. We have a safe dividend yield coming in here at 3.35%. That has been on a streak for the last 45 years, while anchoring in at a 13% average growth rate year over year for the last 20 years. Up next, a company that I personally am hyper focused on and won't stop dollar cost averaging into until 100 shares. We have Visa, ticker symbol V, which is in the business of transaction facilitation. So absolutely nothing to do with lending money, but really we're looking into all the fees that are collected when we swipe our credit cards. Now that business is booming. And I'm going to steal this line from Trump: drill baby drill, let's turn that into spend baby spend, because the more people spend, the more we collect on those fees. We're already up on the year by 5.6%, but within the last week we are down nominally here as we're trading now for $274 per share, down from $290 per share. Zoom out with me really quick to see over 477% worth of share price appreciation over the last decade. And check this out, we have plenty of upside predicted, coming up to a share price of $310 per share. Now, some of you are going to balk at the dividend yield here. It's a bit lower, but understand that the smaller the dividend yield now, the more time it actually has to grow. So you're going to bask in all of that dividend growth. And we're going to come in at a dividend yield of 0.76%. Like I said, small, but averaging 18% year over year growth. That's actually been on a streak now for the last 15 years. Moving right along, let's talk about the salty snack beverage behemoth, Pepsi, ticker symbol PEP. It's been one I've mentioned before on the channel because it has once again slid back down underneath $170 per share, trading for $168 per share right now, given the consumer trend shifts that are predicted. But give it time to recover, because let's zoom out. We see over 168% worth of share price appreciation over the last decade. And right now, analysts remain very bullish on Pepsi, coming in with a solid forecast of $189.89 per share, which is just about 12% worth of upside. Not to mention now we're going to reap all the benefits of this dividend gem, coming in at a yield of 3.21% and a nice 59-year history behind it, while we also reap the dividend growth benefits of 11% worth of growth year over year for the last 20 years. Now we're going to shift gears a little bit and go right back into healthcare with another home run hit, in my opinion, with United Health, ticker symbol UNH, which is a health insurance provider that I've mentioned now multiple times within the past week or so. The company just keeps taking hits, whether it's the impact of medical care advantage rate cuts or antitrust probes. But let me tell you something that's going to shore up your confidence by sharing with you that this beautiful healthcare system in America, a company like United Health, I'll just say, is very likely to stick around for the long haul. So as the stock tumbles right now, trading for $450 per share, while it's got this PE ratio of 20.5, it's quite a buy. Why? Well, zoom out here with me, because we could see the power of this healthcare gem coming in at nearly 560% worth of growth, with an expected share price to climb right back up to nearly $600 per share at $599.14. It's a whopping 33+% worth of upside. And until then, you're going to be able to enjoy the dividend coming in at 1.67%, which remains very reliable after 31 years worth of a dividend streak without reduction, all while enjoying the growth of this dividend as well, coming in at an average of 41% worth of year-over-year growth over the last 20 years. Now, investors, there you have them, all 6 dividend stocks that I am hyped up about. I want you to drop your thoughts down in a comment below, or just let me know if you have better opportunities in mind. Definitely tune in for more insights here, or just subscribe to catch all of the latest.